Hi there, everyone. Welcome to the latest series in the International Macro History Online seminars. It's my great pleasure to introduce today's speaker, who's Rustam Jamilov. Rustam is a postdoc at All Souls College, Oxford. He's also a member of the economics department at the university. He's going to present a co-authored paper entitled Two Centuries of Systemic Bank Runs. Let me just remind those of you who perhaps not participated before of what the rules are. If you have questions, could you please ask them in the Q&A box? If you have a question that specifically is about clarification of something that Rustam has said, then indicate that with hashtag clarification and we can raise that during his talk. Otherwise, we'll hold all questions until the end. Rustam has 40 minutes to speak and then we'll have a 20-minute Q&A. And for those of you who are particularly intrigued by the paper, then please stay on for an additional 15 minutes where you can have a less formal Q&A with Rustam. Okay, please remember that this session is being recorded. Over to you, Rustam. You got 40 minutes, roughly.
Thank you very much, David. And thanks a lot to everyone who has tuned in to listen to the presentation. I'm going to share my slides right now. And David, you can confirm that you see the slides properly. Okay, so this paper, Two Centuries of Systemic Bank Runs, is written together with Karsten Mueller at the National University of Singapore, Tobias Konig and Farzad Saidi, both at the University of Bonn. The motivation for the paper is in the title. Essentially, we're interested in studying bank runs empirically with a macro-historical perspective. The starting point of this whole literature is the classic Diamond-Dubig 1983, and there have been plenty of contributions since then. And the idea of a bank run is, theoretically speaking, very simple. The depositors or agents are running towards, if you can visualize it, they're running towards brick and mortar institutions, banking structures, trying to withdraw their liquidity deposits faster than the next person in line. This incident can arise because generally banks engage in maturity transformation. Their assets are typically very long-term, liabilities are very short-term, and for a variety of reasons, runs can occur. So theoretically, this concept has been studied extensively. It's quite well understood, but empirically, it's surprisingly little in the macro history literature on precisely the causes and consequences of runs. In 2023, with the collapse of the Silicon Valley Bank, the regional banking crisis that ensued in the US, the subsequent regulatory response, there has been renewed interest into this question from among the policy circles, also among academics. If you look at the literature of banking crisis, it's vast. There are lots of very interesting, important contributions that I will list very shortly, but much of the literature focuses on crisis, which are very broad definitions of banking or financial distress. That could be due to runs, that could be due to a decline in bank equity, poor realizations of returns on investment. So crisis as such, or could also be bank failures, which is a whole different branch. But much of the literature does not really narrow down on the canonical definition of a run. And this is where we come in. So we're interested in using a variety of approaches to distill crisis from runs specifically. So we're interested in liability disruptions, sort of canonical runs on retail deposits. We're not interested in declines in bank equity and failures and other subcategories of crisis broadly defined. So I will be even more specific on the next slides. And we take a macro historical view. We focus on lots of countries and many years. So we're not just focused on a handful of developed economies. So in this paper, we have amassed a new cross-country narrative chronology of bank runs. So narrative is essentially a qualitative or econometrician run or human-based definition of an event that we ourselves have categorized based on the reading of historical documents, archival and both primary and secondary historical sources. We have identified in a panel of more than 180 countries over the past 200 years, more than 300 such events that, based on our reading of historical documents, mentioned explicitly occurrences of runs on banks. Well, we could have stopped here, and that in itself potentially would have been a contribution, but we wanted to go forward because at times runs could be idiosyncratic, runs could be on singular banks, and if from a macroeconomic perspective, it might not be enough to trigger a government response or a macroeconomic recession. Again, the Silicon Valley Bank disruption did not really materialize into a full-blown recession. And so some runs can have systemic implications and some don't. So to really tighten up the definition and measurement of runs and really to be able to better quantify their macro effects, we have also created a new cross-country database of bank deposits. As opposed to being qualitative definition as in the first bullet point, the database of bank deposits is fully quantitative. It's objective and it's collected from a variety of sources, and it documents the holding, the stock of deposits at the country level for almost 180 countries over the same time span. So our hybrid approach combines qualitative and quantitative methods to both have benefits and disadvantages in isolation, but in combination, we believe that this is a tour de force of measuring bank runs historically. The key contribution of this approach is what we call a systemic run. It's a theory-based definition, and it's a run that occurs simultaneously with deposit outflows. By combining the narrative chronology with the database of the bank deposits, we find the intersection of the two sets, and 165 runs sit in that intersection, and these runs are systemic. These are runs on banks that were so severe that we could see declines in deposits at the aggregate level. So thus, we call them systemic events. And it will be important. So the whole theme of overarching theme of the paper will be on systemic versus non-systemic runs. While most of our analysis is at the macro level, meaning at the level of a country and year, we complement our main analysis with detailed bank level data in order to really answer some more granular questions. In particular, reallocations of deposits from affected to unaffected banks, and to really understand the characteristics of banks that are being run on more often. To that end, we will use two data sources, one from the national banking era in the United States, and the other from the more recent time frame from 1976 until 2020, using the US call reports. So while this particular section is US focused, all the previous analysis is for for the quasi-universe of countries. Okay. So a quick preview of the findings, also in case I don't get to them in the end. We start with a series of stylized facts, probabilities, and likelihoods that would hopefully enable theorists and quantitative economists to calibrate models with systemic financial crisis. So the first order question is, how frequent are bank runs? And we find that depending across a variety of different approaches towards measurement, the unconditional likelihood of a run is about 1.2%. Conditional on the banking crisis, where banking crisis is a broader definition that includes declines in equity, for example, the probability of a run is 46%. So what that means is runs and crises oftentimes do occur together, but not all the time. So these are two distinct types of events. One is a liability-based disruption, and crises are typically more equity-based disruption. So more on that in future slides. The unconditional probability of an aggregate deposit outflow, that's our quantitative measure, is about 12.7%. The unconditional probability of a systemic run, meaning a narrative run that also that happens together with an aggregate deposit withdrawal, is about 0.6%. Well, you might say these are very infrequent events. Fair enough. But what we're interested in is not just the likelihood of certain incidents, but also the elasticity of the economy towards those incidents, conditional on them taking place. Because an event could be low likelihood, but it's disastrous if it does occur. So what we find is that there are significant economic and statistical differences between the aftermaths of systemic and non-systemic bank runs. In particular, the impact of systemic runs is very detrimental on the real economy, on the real GDP and credit provision and so forth. But the impact of non-systemic bank runs is very, very much smaller. It's about 1/3. It's often statistically indistinguishable from zero, and it's across the board, across all of our specifications, it's much smaller. So it is important to really, not just from the policy perspective, but also academically, to distinguish systemic from non-systemic runs. So that's why we argue throughout the paper that our quantitative approach towards measuring deposit withdrawals is really helping us to understand better the impact of runs on the economy. A big question in the literature is the nature of runs, systemic or otherwise. There are two branches essentially, and one side, so that based on the canonical Diamond-Dubovik model, argues that bank runs are caused by non-fundamental triggers, shifts in beliefs, sunspots, if you will. And the other side would say, no, runs are optimal events that occur due to fully rational, measurable, and predictable characteristics. So think of the papers by Allen and Gale on optimal financial crisis and so forth. So we find that in our database, systemic bank runs are contractionary even when they are not triggered by fundamental macro causes. So that gives empirical support from a macrohistorical perspective for the Diamond-Dubovik line of thought that even when we don't observe fundamental macro deteriorations during bank run episodes, the economy still suffers. We also find that systemic bank runs are contractionary when they're not accompanied by declines in banking equity, so by banking crisis, or when banks do not fail. Because one could think that the first order issue is bank failures and all the associated regulatory, legal, accounting costs, which are deadweight losses for society, for example. But even when bank failures do not occur, a run is enough. A liquidity disruption is enough to generate a contraction in credit, which feeds into the real economy. We study a variety of supplementary questions as well. So in particular, we look at the heterogeneous effects of runs. We find that capitalization of the banking sector can act as a cushioning buffer so the impacts of systemic runs are smaller if the banking sector is less leveraged, but they're still statistically large. You might think, well, what can we do from the regulation perspective? How can we prevent bank runs ex ante, and ex post, what can we do to limit their impact? We find that in ex post terms, liability guarantees are the best policy tools to prevent the full-blown run and panic, which makes sense because a liability guarantee is a limit on the withdrawal of it's essentially in a cap on how much liquidity the household will lose, and conditional on that, the urge to run to the bank diminishes. So potentially that could work. Theoretically, that we can write models on that, and also empirically, that's what we find. From an ex-ante regulation perspective, we find that a lot of the times it's very hard to completely nullify the impact of bank runs. The only correct institutional factors that we found that quote unquote work are central bank existence and deposit insurance. But even in these two cases, the impact is not very strong. So, but even conditional on having deposit insurance and a well-defined independent central bank, the impact of runs is still there. Finally, we find at the bank level, we'll find that there is a lot of reallocation of deposits during a bank run episode. Deposits are being relocated from high leverage to low leverage institutions because households typically run on high leverage banks. So now the preview of the result is complete, and I think I will just continue with the presentation of the paper, unless maybe there are some.
Rustam, let me just ask a quick clarification question. So, Camilo Blanco asked, how do you define the time window when you're thinking about bank runs? You know, what length of time are you allowing for deposit withdrawals to take place, which would determine whether or not?
So that's a very good question.
Systemic.
Yes, that's a very good question. For the narrative-based definition, we are defining a run happening within a year. So because it's annual data, so we do in a lot of times, in most cases, we know the exact months of a run, and we do in the paper that I will not be covering that today, but in the paper we do month level regressions analysis, if you will, for the subset of narrative runs for which we know the exact month of the event. So that's a little bit more high frequency than annual. For the deposit withdrawal data, what you have seen and what you will be seeing today is an event that includes potentially 2 years of a deposit withdrawal. So we're trying not to double count deposit withdrawal events. So there are 2 years with negative deposit flows. We will count out as one incident. But for the macro results will not change if we define the deposit withdrawals as happening at the year level, but only the frequencies will naturally be more elevated. Okay, so I will continue, David. Any other question?
I just carry on. There'll be other questions, so just keep going.
Okay, so I will carry on, but then I will make another pause in a few slides. So just to give you a summary of how our data set compares to the existing work, we're so to speak, we're building on the shoulders of many giants. So there are lots of canonical papers in the literature: Reinhardt and Rogov, Lavan and Valencia, Jordan Schularik-Taylor, Baron Werner, and Xiong. As you can see, in terms of the coverage of years and countries and the number of observations, we have very good coverage, but in particular, our methodology is quote unquote a little more state of the art than some of the existing work. We're building methodologically on Baron et al., who were one of the first, the first to propose the mixed approach for identification. In that paper, a banking crisis event is defined based on narratives and a decline in the value of equity of a bank. Our approach is complementary and looks at the narrative definition, but complements it with the quantitative data on deposit withdrawals. So we're interested in liability disruptions, and this is what the column narrative only means. So we don't have only a narrative-based approach. We have a combination of qualitative and quantitative approaches, and Baron et al. have something similar, but with the focus on equity. Okay. So a few more details on our deposit withdrawals data. We are focusing explicitly on retail deposits by non-bank customers. So we are not looking at interbank deposits or the so-called wholesale funding market. For two reasons. A, the data coverage is not very good. That would be by itself a whole different paper, different undertaking. But even as of today, it's only a small fraction of all deposits globally, including all the emerging economies. For most of our observations, we can split deposits into demand and time, and we in the paper provide results for demand and time deposits separately, and the coverage, and I have mentioned before, and our sources are usually the international financial statistics from the IMF and also country level databases. I think all of our data sources are publicly available. So that's a snapshot of what we mean by systemic bank runs. So that's the core idea of the paper. We have 300 narrative events. We have 3,000 deposit outflows. Incidents, the intersection of the two sets, about 165 incidents, constitute systemic bank runs across countries and time. So this picture shows the time series of bank runs that defined based on our narrative definition. So the blue line with circles is our main time series construct of narrative-based bank runs. The black line with squares is the measure that we construct ourselves. That's an index of banking crisis, which is based on the 4 papers that I mentioned some slides ago. Reinhardt, Rogov, Lavan, Valencia, Jordan et al., and Baron et al. We combine them and construct a so-called unified measure of banking crisis to compare it to our measure of bank runs. What we can see is that in most years, runs and clearly there are more crises than runs in any given year, because the definition of a crisis is broader. But there are some periods when there are more runs than crises as well, and the two time series are correlated but not perfectly. We notice many of the sort of the stylized patterns that have been documented elsewhere in the literature. The turbulent early beginning of the 20th century, the calm of the 50s, 60s, and 70s, then the turbulent 80s, And then in recent episodes, we have a few run-like events as well. And in the paper, we have a lot more time series plots for developed and emerging countries, for example, separately. So in this slide, we conduct a validation check, if you will. We are looking at whether bank run events classified by our narrative approach, whether those events coincide indeed with deposit withdrawals. Remember that the deposit withdrawal and the run data are based on completely different data sources. They are built on from different underlying microdata, but hopefully they should be capturing the same object. So on the left subplot, we plot the distributions of deposit growth rates in bank runs, which is the solid line, and any other time which is a dashed line. So we see that the distribution of deposit growth rates is shifted leftward with a potentially slight increase in left skewness during episodes of runs. So there is a correlation between the way we define runs from a narrative perspective and quantitative deposit data. Here on the right plot, we see this correlation even better, if you will. We look at event studies, so to speak, where at period 0, we have a run defined based on the narrative classification, and on the vertical axis are changes in deposits from the deposit withdrawal data before and after the run. So the significant decline precisely at the time of run confirms that what we're measuring is in fact reasonable. And this contraction is lasts for quite a long time. So some runs coincide with declines in deposits, and that's what we want, essentially. So this table provides unconditional and an array of conditional probabilities of runs. I will not go through every single number. That I will leave some to the listeners and to the readers. I will just highlight the unconditional probabilities again. They were mentioned in the introduction, and also the conditional probabilities, which are not 100%, and so runs conditional on a banking crisis or panic are not guaranteed. And vice versa, crisis conditional on a run are not guaranteed. Obviously, they're correlated, and they do happen a lot of times in conjunction, but they're not one and the same. Okay, so this figure plots the first key, if you will, result of the paper, the macroeconomic cost of systemic bank runs. We find that systemic bank runs, that's narrative runs that happen together with deposit withdrawals, cause significant declines in real GDP, real deposits by construction, but also in real credit. And the effect is large. So GDP declines by about 9%, 4 years after the start of the run event. And the effect is also very persistent. The impact on credit in particular is quite large. It's about 28-30%. So this is the impact of systemic runs. And this figure is also not the main result of the paper. So this figure is the main result of the paper. This is where we compare systemic and non-systemic runs. If you compare blue lines with squares and red lines with circles, across the board, for real GDP, for real credit, you find that it's systemic runs which have detrimental macro effects. Non-systemic runs have muted impacts, and for many quarters they are turning, they're becoming noisier and cannot be distinguished from zero. So once again, so the key result of the paper is that runs that are accompanied by deposit withdrawals are significantly more likely to cause macro distress than just runs on which are not systemic. In other words, if you will, there are systemic and then idiosyncratic events. So we can also, because the deposit withdrawal data it's a continuum, we can explore the intensive margin of deposit withdrawals, and we get a picture that looks like this. This shows the impact on real GDP up to 4 years after the start of the systemic run, conditioning on different levels of deposit withdrawals. And we get this very nice monotonic relationship that the greater the deposit contraction during a run, the more severe the macro consequences get. If there are no deposit contractions, you're back to the non-systemic run case. The impact is negative, but it's quite muted. But if the deposit contraction is very large, then the macro effect is greater. That's the intensive margin of our deposit withdrawal measure. In the introduction, I mentioned the important distinction between fundamental and non-fundamental runs. Using a narrative-based approach, we identify for every single run episode, we identify whether there is a concurrent macroeconomic crisis or not, where that is defined by a monetary policy contraction, the capital flight, or any other crisis that is mentioned in the historical text. Then this allows us to classify all systemic runs into non-fundamental based systemic runs that are not accompanied by a macro-based fundamental recession. And we find that that has limited effect on our results, that even when runs are non-systematic, they're slightly less, the impact is a little bit less, that's intuitive, but it's still statistically large and quantitatively very similar to the baseline. What that means is that when runs are not accompanied by fundamental recession, so now I take a leap of faith. If runs are more likely to be caused by behavioral shifts and sunspots, the macro effect is still there. So in a way, our results are, pushing us towards the Diamond-Dybvig interpretation of the nature of runs.
Sorry, Rustam, can you spell out
Yeah.
how are you, within your data, how are you defining non-fundamental here? Because the decline in real GDP is, there's a slight difference, but it's still large, right? So what is it precisely you mean by non-fundamental here? I understand the behavioral point, but
yes. So it's a narrative-based definition. It's our own reading of the historical documents. For every narrative run that we observe, for every incident, for that year, we look across all the resources available and we find evidence of whether there was a monetary policy contraction, a capital flight, a drastic exchange rate depreciation, or any sort of mentioning of economic distress. If we don't find any evidence that there was a large monetary policy contraction in that year, we say that, well, there is no fundamental reason for this run to happen.
Okay.
That's what we do.
Okay. But you've got about 10 minutes, by the way, just.
Okay, thank you. Yeah. So next, in a series of figures, I will be trying to convince you that systemic runs have macro implications even when they're not accompanied by banking crisis and banking failures. So here we see that when you isolate systemic runs from banking crisis that could include declines in equity, the macro effect is still there. The bank equity returns picture on the right it's very nice because that really shows this message very clearly, that for systemic runs, we see virtually no change in bank equity returns on bank equity, but for banking crisis, we see a large decline, but yet the macro effect of runs is still there. So there is a distinction. There are different origins of different types of crisis. So similarly, if we isolate systemic bank runs from banking failures, we see that the impact on real GDP is still there. Sort of obviously, if there is an overlap of the two events, if you have a systemic bank run that is also accompanied by a cascade of bank failures, clearly the impact on GDP will be larger. But if banks do not fail, but we just observe a liquidity disruption, there will be a negative effect on real GDP. And the picture on the right with equity returns makes the similar point as to before. So we have looked at a variety of heterogeneous effects, trying to understand what characteristics of countries make it more and less likely that runs are detrimental. So one thing that comes to mind immediately is capitalization ratios of the banking sector. We do find that when the capital ratio is higher than the average, systemic runs have a slightly less detrimental effect, but it's still there. So again, supporting in a way the idea that runs are non-fundamental, non-forecastable, really sunspot and behavioral driven events, and the capital ratio can only do you so much against these behavioral incidents. So for government interventions, so we have used the data from the famous metric and Schmelzing database. We have used their measures of government tools and interventions. The only one that we have tried many, and we have additional pictures in the draft. The only that we have found that works reasonably well is the first one, liability guarantees. So if you compare the impact on real GDP for systemic runs with and without ex post liability guarantee introductions, we find that the impact of a run with a policy intervention is much lower, but it's still there. But the impact in terms of point coefficients is almost halved. So we find that liability guarantees do work on a large sample of countries and years. So this is where the main analysis of the country year level variation ends, and I will show some complementary pictures on bank level data that we have, and we focus on the national banking era in the United States and the recent episodes, the recent 3 decades, as I mentioned before. So you might ask, what happens to deposits during the run? Is there reallocation or reshuffling of deposit during panics? And the answer is yes. There is a lot of variation in deposit growth rate during systemic runs and in other times. In particular, the distribution of deposit growth rates is substantially more negative during systemic runs than in any other events. Okay, and that applies particularly strongly to the national banking era. To some extent, also for the recent decades for the call reports data. So good. Can we understand now? Can we ask a follow-up question? What are the characteristics of banks that are more likely to suffer consequences during a run episode? And here we plot we zoom in on 3 bank level characteristics: the debt to asset ratio, the profit to asset ratio, and the share of non-deposit funding to total liabilities. And we find that there are significant sources of heterogeneity at the bank level. During run episodes, banks that are more reliant on that have higher leverage, that are less profitable, and that are less reliant on non-core funding, are more likely to experience larger deposit withdrawals, and therefore more likely to fail and to contract credit to firms and so forth. the same picture, slightly noisier, but the same picture rises for the recent decades using the call reports data, high leverage, low profitability, and reliance on deposit funding is the source of heterogeneity for the impact of runs on deposit withdrawals. So I have 5 minutes, I believe. That's right.
Yeah, at the most. If you
At the
could
most,
get to
yeah.
less than that, that'd be great. But yeah.
Yeah. Okay. So I think yes, I think I'm getting to the end as well. So a similar question that we have answered at the macro level, we can answer at the bank level. So what's the aftermath of bank level deposit withdrawals in the national banking era and in the recent decades? So banks that suffer larger deposit outflows are significantly more likely to issue fewer new loans to non-financial firms. Their deposits contract by construction, their liabilities get disrupted, and the reduction in loans is the cause of the real GDP decline. So this picture helps to really understand the economic mechanism of some of the macro results that I've shown before. And a very similar result is for the call reports data, significant difference between banks that suffer and banks that don't suffer deposit outflows is leading to a differential in loan provision. So I have a couple of case studies that are also in the paper, but I think I will skip them and just get straight to the conclusion. So we have provided a new macro historical database on bank runs. We have a hybrid approach that combines qualitative narratives and our own reading of the historical data with a quantitative deposit withdrawal data that we have assembled. We have new insights on fundamentalness and systemicness, and we have provided a new stylized fact that should help structural macroeconomists and theorists to calibrate their models. What are the potential areas for future research? Well, like I've mentioned before, we don't really focus on wholesale funding and interbank markets. That's an area for future work. And one application that we're working on at the moment are rare disasters and asset pricing in combination with our bank run data. That's it. That concludes my presentation. Thank you very much, and I look forward to your questions.
Okay, great. Thank you very much. Okay, let me start. We've had several questions asking about how you control for bank regulation by central banks and more generally changes in bank regulation over time when you're identifying and modeling bank runs and their impacts.
So I will unpack this in 2 points. So first, controls. I will get to regulation in a second. So I haven't had time to speak precisely on our econometric specification. We control for a variety of lagged aggregate characteristics. When we do aggregate analysis, when we do bank level analysis, we control for a variety of bank level characteristics. Clearly, regulation is an aggregate factor. When we do bank level analysis, that will be absorbed with time fixed effects and aggregate time varying factors that we can control for. At the macro level, so we look precisely at government regulations, both ex ante and ex post. So one picture that I've mentioned in the presentation is just an example. We study deposit insurance at great depth. We identify the years for each country in the data, the years that deposit insurance was introduced, and that enables us to understand how the dynamic changes in regulation affect systemic runs, both the likelihood and the impacts. In particular, if I remember correctly, we have a table that separates all runs based on before and after the introduction of deposit insurance. So we take the dynamics in the bank regulation quite seriously throughout the paper.
Okay. There's a longish question from Chris Meisner, so I'm going to unmute him and let him fire away. Have I done that? Can you?
Yeah, hi.
Hi.
Hello. Yeah, thanks. I just had some questions about like the fact that, GDP quality and the data just is really bad as we go back in time. And, kind of seems like, your sample's shrinking as you go back in time. And so making these like long run pooled comparisons seems, courageous at best. And then another thing that I missed maybe in the talk is I would have really liked to hear something about how you build your bank run narrative database. Like I didn't really get a sense of like what sources you used, what decisions you made. I think of like Andy Jalil's work, which laid out in gory detail, like all the sources and all the local bank runs and stuff versus what I saw here, and I'm just not getting the full picture, I think. So those are my two data comments.
Yeah, thanks a lot. These are very important points. So on the first one, quality of data. I mean, clearly there is nothing anyone can do with GDP quality data going back to 1800s. So we have run lots of subsample robustness tests. So our macro impact results are quite robust to different definitions of the sample. So it's not just for so it's not just for the pool sample between 1800 and 2023. Similar results are obtained if we cut the sample at different periods, and similar results are obtained if we just focus on emerging or advanced economies. And I could argue that the quality of data, even when going back in time, is slightly better for advanced economies, and if the results do not change, so that's not really a major concern for us. For the bank run definition, that's a good point. So for that specific question, we have over 150 pages along appendix in the paper, and I didn't have the time to go through each and every detail. So, but as it's very well known in the literature, the narrative-based definition is roughly as follows. Humans, including four of us and around 20 research assistants, go through, for each country, for every year, go through all the existing historical data, such as newspapers, when available, central banking data, existing data sets of historians of a particular country. For instance, if we're studying Germany in 1870, we're trying to look at what the local economic historians have written on that episode. And then we have a predefined sort of characteristic search characteristic that we're looking for. And we're looking for precise things. So we have a very strict cutoff rule for whether an event goes into the database and whether it doesn't. And we want exact evidence that a retail run on a brick and mortar institution has happened. We want evidence that people were trying to withdraw their liquidity, that they were running on the bank, that we do not classify as a run anything that just vaguely mentions deteriorating banking conditions. We want something more precise. And if you want, there are more details for every single episode, for every single run in every single country. We have the texts, the actual narratives that we have used to make our judgment. And if they're all available in our website. If you find for any country or any year that we have misjudged a run, or if you think that we have missed something, please shoot us an email. So that would be also extremely helpful.
Sorry. I know Rui's got his hand up, but let me just. Anne Job has asked a question which follows directly on from the previous discussion, and she asked, her comment is the narrative effect is going to be substantially different in previous eras than the modern one, with the arrival of social media, etc. Do you have a view about that?
So that's a good point. So if we had a strict time invariant sort of dictionary of words, and we were just going through every piece of newspaper data and comparing words to our dictionary that is fixed, that would be a big problem, because that dictionary needs to be flexible enough, because the definition of a run changes over time. So we have taken, that's why we do not do that. In fact, that was one of the ideas that we had before. Let's just use natural language processing and textual analysis. Let's have a dictionary of what it means to have a bank run, and let's siphon through every word of every newspaper available, and then try to identify, just do word counting. And we quickly realized that that's a very bad idea, precisely for this reason, that because what constituted a bank run or a liquidity disruption in 1850, it's not the same as in 2020. So how do we do that sort of quote unquote scientifically? That's a very good question. So at the end of the day, it's still, the narrative identification is still based on human judgment. And you can say that it's flawed. And I completely agree with you, because there is so much the econometrician can do. We have our own biases, and we, even ourselves, the four of us, we differ in what a run should be. Because some people would say, no, a run must be a textbook Diamond-Dubik definition. But then potentially you're not capturing some of the more, I mean, what is a bank? Do you capture, building societies? Do you capture the runs or liquidity disruptions in the UK in the 70s or the 80s? That's also the reason why we have the deposit withdrawal data, which is a little bit more scientific, if you will, because the narrative approach suffers from human judgment.
Okay, Rui.
Thanks. I mean, this is great work and a very welcome addition to the data sets. Since this is the narrative approach, right? There's always the obvious questions, right? So how strong is your trust in your classification? Is there a way of falsifying it, right? So if you disturb, right, the simplest possible way, if you disturb your measure of systemicness or fundamentalness by a random error term, what would happen to your results? I know its error in the measurement is going to bring down the results, but how bad has the error to be in order to make your effects insignificant? Or can you think, and this goes back to the previous discussion, can you think of some cases of possible bias in your sources that would lead to a non-classical measurement error? And can you simulate that and see what that would do to your classifications, right? And if it doesn't do much, then you're in stronger grounds. Now, if I understood correctly, you say that in your quantitative part, right, you focus on domestic deposit withdrawals, no international bank runs, right? Because you want to identify those. Although you then control for that when you talk about fundamental runs. So if you have a capital account crisis, that would count as a fundamental run. But if I understood correctly, that's not part of the definition, right? So if you think of the 1931 German banking crisis, a pretty famous one, which was clearly driven by external deposit run. So what does that mean? You classify that as a banking crisis, but not at a bank run, although you then say that there were fundamental reasons for it. And if so, I'm not sure I would agree with it. Thanks.
Thanks so much, Rui. Very good, very knowledgeable questions. So our definition is strictly a run that is originated by non-bank agents. So in that case, we would capture any run that has international causes. I think we have a robustness where we isolate runs that happen together with like military events, invasions, exchange rate movements, capital flights. So that those are clearly international sources of variation, and our results do not change. But just to answer your question very simply, so the example that you made, we would capture them both for the crisis measure and for the run measure. Then, conditional on that, then we could classify things into domestic versus non-domestic sources. That I don't believe we have done. So that's a very good suggestion that actually we can do. And for measurement, so that's a sort of a classic standard concern for the literature. One result that is very reassuring for us is that whenever we compare the impact of runs versus crisis, bank equity returns acts sort of as a validation check of measurement for us, because runs are always associated, crises are always associated with declines in returns on bank equity, but that's not true for the impact of runs. If we were measuring runs inaccurately, if we were over measuring things, if we were capturing banking panics or failures that are much broader than just runs, then that should not be happening. So that's one of the tests, and we do some sort of standard sort of robustness checks in the appendix, but definitely something to think more about.
Okay, we're almost out of time, but we've had a few questions on bank runs in developed versus developing countries. Can you show anything, Rustam, if you partition your sample along those lines? I think you said that there was no difference, but is there anything that you can share with us?
Yes, I have to improvise, but
there may not be time, but we can just talk to it.
So one thing that I can show right now is the following picture. If it works, that would be great. Yeah, so that's directly from the paper, and that's just the time series plot of runs and crises for advanced economies and emerging economies. So the patterns are quite similar, both in terms of the trend, the cyclical component, but also in level. So that was very interesting. So we never found that runs are more likely to occur in emerging countries. Maybe that's not surprising for many of you, but to me it was. Well, it turns out exposed that clearly for a run to be more likely, you need to have some sort of banking penetration and some degree of financial sophistication, which correlates with an economy being advanced, which increases the likelihood of a run. And there are some other tables as well in the paper, and lots of supplementary pictures. So the broad idea is that there is not much of a difference between the likelihood and elasticities of runs in advanced versus emerging economies, particularly in the recent decades.
The 19th century, is the US on the left or the right?
That's a good question. My bet is it's on the left, but I would have to check. That's a good question.
It should be on the right, probably, depending on how you make the definition. Anyway, that's a story for another day, because we're out of time. You've had lots of questions, some of which we haven't managed to get to. So I encourage those of you who would like to stay on for the 15-minute continuation. All that remains for me is to thank you for joining the seminar, and to remind you that on the 16th of October, we've got Bruno Capratini from St. Gallen, talking about fighting for growth, labour scarcity and technological progress during the British Industrial Revolution. Thank you very much.
Okay, and so now we're in a more informal setting where we can show our faces. Rustam, I was surprised by how strong and persistent your results are, but especially that they increase over time, right? I'm sure you checked for this, right? But GDP can just be integrated, right? So are you sure those variables are stationary and there's nothing strange driving your strangely piling up results?
So, results look like an impulse response. I've showed up to 4 years.
No reverse, right?
They reverse eventually, but the effect is very persistent. That's true. So if I showed you, that could be a good idea to show more, just to show more years.
Mm-hmm.
I'm pretty confident that there's nothing fishy going on in terms of us forgetting to unfilter some variables. So, and the reason I'm confident is because similar patterns can be seen in all of the other papers that we're citing. For example, in the paper by Ricardo Reich and co-authors 2, I think the impact is also 10%. In Werner Schong and others. So the number to remember is that GDP falls by around 10% after significant banking distress events, depending on how you define it. So these numbers are not unheard of. So they're very much in the ballpark. But also you probably remember the large and persistent effects of systemic runs. These are very particular events that are accompanied by actual measured deposit withdrawals. If you don't take that into consideration, the impact is 3%. Still a lot, but it's very much more muted. And so the systemic runs are less, they're less likely. So they're quite rare. So they're almost like disasters.
Yeah. I'm essentially wondering how long it takes to revert, right, back to trend.
So it takes up to 8 years, but I don't have the picture, so you just have to take my word.
Okay.
Yeah.
Okay. Good.
So there was a question from Samuel, who's not, I think, still on. I can't see him.
No.
So let me just read it out. I mean, he's saying, beyond regulation, I'm wondering how monetary regimes and changes in quote unquote the business of banking, he's quoting Goodhart here, Charles Goodhart, are factored in. Also, what about the rise of shadow banking, especially in the aftermath of the introduction of the Basel rules?
Yes. So these are good points. So on shadow banking, we don't have much to say at all, but on purpose. We're focusing on a very specific definition of a run, and shadow banking, interbank markets, wholesale funding are a very relative from the historical perspective, are very recent phenomena, and still even today are concentrated in a handful of countries. So for the majority of the sample, both in terms of the cross-sectional variation and the time variation, we just didn't think that this is a first order for this paper. But it's clearly, especially today for US economy, for developed markets, I mean, clearly this is important, but we don't really have much to say on shadow banking.
But for the bank level data in the United States, shadow banking, Carola Friedman and Eric Hilter got that paper right on trust banks in the early 20th century. So I don't think that would be true for your US
true meaning we can do it. Of course, you're correct that for US bank level, of course, we can do it. The question is whether we want to do it in the context of this paper. It's not part of this paper because that distracts from.
Yeah, I mean, it's already 70 pages, your paper, so.
But I agree. So maybe for a different project, we can. Yeah. So, but also monetary regimes. Yes, that's so. I partially covered that with the analysis of fundamental versus non-fundamental causes. We do lots and lots of case studies at the level of a country and the level of an episode, such as the Great Depression, for instance, or for particular countries across time. So in that case, so monetary regimes are more likely, much less likely to have any effect. We have some additional tables where we classify countries by the degree of financial development, the presence of a central bank or not. But you see, but I guess what the question is asking, we have never really looked at the impact of monetary policy shocks on central bank on bank runs. We haven't looked on that. That we haven't done.
Okay. And George Perendi has a question, which I'll unmute you, George, if you're still there.
Yeah, sorry. Yeah. Well, basically, the two questions. One is how many or how frequently do you think the bank runs caused GDP a drop or recession? And do you just consider that because a bank run may precede, should I say, perception or recession, it means it is a cause?
Yeah, you're asking a tough question for me. So to what extent any of this is precisely causally identified is a good question. So there's a limit to what you can do at the macro with the macro time series at the country year level. Causality is very hard to claim. So a lot of the macro variables are correlated, but there are some things we can do in order to push for some causality in our results. For example, all of our specifications control for pre-event for lagged characteristics, for lagged GDP, for lagged credit to GDP ratios, and so forth. So if you believe our econometric specifications, then we can argue that runs, if they are indeed randomly assigned, and to the extent that they're not fundamental, they are potentially randomly assigned, then the impact is exogenous, quote unquote. Because to claim causality at the end of the day, we really just need to prove that runs just happen randomly. That's very difficult, but there is some evidence for it. Plus, with the abundance of controls in our specifications, we believe that runs are not just reflecting what is going on in the economy, but they're really triggering some, they're causing, quote unquote, rather than just preceding, using your words.
Thanks.
Anne, you had several questions. I don't know whether you feel that they've been adequately answered. If not, now's your chance. If you're there. Okay. I think Rustam, I think we're probably done. We don't have any other questions here. Okay, let me just ask one last question. I mean, there's quite a number of findings in the paper. Some of them, you're quantifying things maybe we didn't know about, but some of them just didn't seem that surprising. What is the most surprising thing that you think you found?
Well, I can answer this question without speaking for my co-authors. So just myself personally, I was extremely surprised that when we condition on the fundamentalness picture, that when we look at fundamental versus non-fundamental runs, I was extremely surprised because I'm trained as a macro theorist, and I'm trying to think about the diamond Dirac paradigm from the modeling perspective. And this debate, quote unquote, has been going on in the literature for a very long time. Where do runs come from? Are they behavioral, non-behavioral? How do we actually capture that in the data? We have done a first pass at this. It's not perfect. Maybe there is another paper to be written precisely on this question, and we can engage large, language models and some sophisticated techniques. But what we have done is a first pass at cracking this the question, because that has theoretical implications. And the fact that we find that non-fundamental runs are still detrimental, that was very surprising, because I was always trained into the in the rational school of thought that crises are rational, they're forecastable.
Yeah.
But I was very surprised. So potentially a second paper that we, if we ever write a second paper, that will be precisely on this.
Yeah. I thought that was what you're going to say. And I mean, for what it's worth, you might think about writing this paper to emphasize that point, because, maybe that's going to have a bigger impact.
I agree.
I can send an email to Farzad if you like.
No, I think we're all on the same page.
Okay. So we're done, yeah?
I think so.
Okay, thank you, Rustam. You
Thank
did a
you.
great job.
Yeah.
Thank you. I've
You
learned
too,
a lot.
David.
Thank you very much.
Thanks, everyone.
All right, bye-bye.
See you.
Bye.
Bye-bye.